Hello, my name is Neil George, and you are joining me live at the Money Show in Dallas, Texas, which we are also airing currently on Facebook. And joining me is Jim Woods. Jim Woods is editor of Successful Investing and has been in the financial markets for a number of years. Jim, why don't we kind of go through a little bit of the lay of the land? Today's market activity has had people a little concerned. We had a little drop in some of the major indices. Day before we had a little jostling in the Treasury market. Where do you see the market, which has done so well for us for much of this year? What's sort of your general outlook?
Yeah, I mean, it's funny because days like today, where you have finally start to see yields rise, and they really haven't done that. They haven't risen as they should have, in my opinion. To me, it's kind of a virtuous rise in yields, because the reason why real yields are rising is because we got strong economic growth, we got a stronger dollar. These are positives for the market in general. So I think the only concern is if it rises too fast. If we start seeing a very sharp rise in yields, that could spook markets. We did see a spook in markets today, but I think that's to be expected after all these. We've had record highs from numerous record highs this year.
And people have to start realizing that 100 points a day on the Dow or 100 points a day on the S&P, not quite as meaningful as it used to be.
Yeah, I mean it's
kind of like the dollar. The dollar doesn't buy what it used to.
Exactly. Well, I mean even a 100-point drop on the Dow is only like a 0.4% decline, something like that.
Which can be an average day.
That used to be like a pretty average day, but it was only 50 points maybe. So if you're looking at the markets and you're seeing these big headlines, 300% or 300-point drop in the market, 300 point, 30 point in the Nasdaq, that is something you shouldn't get automatically scared about. What you want to get scared about is if you start seeing a consistent trend that goes down, and then that could signal something worse.
Now the interest rate in the credit markets, we had a little bit of a gyration in the Treasury market. Yes, there were some technical reasons for why that was occurring. The Treasury market has obviously been gradually, giving up some pricing, yields and kind of backing up a bit. But as you said, it has not been a dramatic. It's been a gradual process. But at the same time, we've seen other sectors of the bond market, the corporate bond market, because the higher yields done exceedingly well. Municipals, other sort of credit stories are doing well. What is your outlook, on the bond side?
Well, I think the one thing that we can say now is there is long-term yield risk, and if you can shorten the duration on your bond portfolio, that's probably the way to go at this point. Start to look at the ways to reduce that long-term risk.
So in duration, for those that are watching, we're looking at a measurement of interest rate to price sensitivity.
Yes.
So generally, the shorter the maturity, that basically means that the price movement is going to be for respective change in yield, it's going to be less. So you're taking on less risk.
Yeah, you're taking on less risk. You're taking on the big thing with bonds is interest rate risk. If you have the bond and interest rates go up, that's not helping you right. So if you have the shorter duration where the yield is not as volatile, you're automatically decreasing your risk, and that's the better way to go if you're a fixed income person.
So along that line, a lot of things that you've been doing within Successful Investing is utilizing a lot of the ETF marketplace to position your readers for various tactics. Since we're in the bond market, as part of our conversation, where in the ETF space are investors looking for yield, looking for participation in the bond market?
That's a great question. Well, just coincidentally, last week I recommended an ETF called FLOT. It's a floating rate ETF, and that's something that I haven't seen a lot of people go into, but it's become something that I think will help investors mitigate that risk. And it's because the way these things are somewhat complicated, but the way the ETF is structured is it kind of follows along as rates rise. You start getting into and you're able to actually participate in that rate.
So in a traditional floating rate bond, if you're buying it into a floating rate bond, the interest rate will be reset based upon some sort of target interest rate.
Some benchmark, exactly. LIBOR or something like that.
Right. So, but within the ETF space, since you're dealing with an underlying creation unit, you must have a lot of synthetic work going on under the hood.
Yeah, there's a lot of things. Something that would be difficult for you to do at your own, but it's something that through the kind of one of the biggest benefits of ETFs is you're allowed to you can get exposure to that area without just one click.
And who's the company that's running that?
It's FLOT. It's the Good question. Look it up. FLOT.
FLOT.
Is the ETF. Yeah. It's the. I believe it's the Van Eck.
The Van Eck.
Yeah.
Okay. Cool. So, and then let's turn back. Let's shift back to the equities where we were talking a moment ago.
Okay.
You know, again, we talked about that. Yes, we saw a little bit of gyrations, not as big a deal percentage-wise. Yet the market's been doing very well for this year. A lot of people are seeing a lot of green lights in the economy.
Right.
Are you sharing that green light
I
perspective?
do. I mean, we've had economic growth is as good as it's ever been. I mean, maybe not historically if you go back and back, but in a long time we have not seen the economy as strong as it is now. And not just the hard numbers like the GDP growth, but also just the sentiment indexes, which is what a lot of CEOs use to put money to work. They say they say, okay, you know, we think the market, we think taxes are going to be favorable, we think consumer spending is going to be favorable, we think manufacturing is going to be favorable. So they put money, they start putting CapEx to work, and that starts to bring the market up again.
And again, along that line, I mean, Bloomberg has a consumer sentiment index called the Bloomberg Comfort Index.
Yes.
It just hit a new high that we haven't seen since 2000.
Yeah, all these sentiment indexes are telling us that CEOs and professional money and just the consumer in general is feeling really good about this market. And I think as long as that continues, and as long as the hard numbers continue, I think we'll see that as a tailwind on stocks, regardless of these little blip days.
So how are you structuring people as far as recommendations within the ETF space?
Well, certainly I have exposure to broad-based ETFs like the Vanguard, VU ETF, the SP 500 ETF, but also have sectors. One of the sectors I'm bullish on and I've had for about a year and a half is defense, aerospace and defense. ITA is the ETF. That's up something like 50% in the portfolio right now. So that's a way to do it. And then I still like big cap tech. I mean, there's a lot of today it got sold off, but
yeah, but that area has been one of the better.
It's been one of the best performing sectors. So that's the one.
Now, within some of the recent changes in the S&P's characteristics for some of their gig contracts, has that impacted any of your tech space as far as those ETFs?
Not really. I mean, I haven't really had to adjust much to that. I continue to kind of stay the course with those ETFs. So unless I need to start doing something with that, I will. But at this point, we haven't had to.
So the general market, keep your exposure there. Look at the bigger names, tech space.
We're still in a confirmed bull market until we see the indexes go substantially below the 200-day average. I'm still going to be in the markets.
Jim, thanks very much for your thoughts.
Thank you.
That is Jim Woods. He's editor of Successful Investing. I'm Neil George, and you are joining us live at the Money Show in Dallas, Texas. Thank you for watching.
Thank you.